Good afternoon. My name is Daniel Thomas. I'm the Chief Business Correspondent for the Financial Times, and it is my pleasure to welcome you to the first FT Board Director event. This is part of our pilot programme to create a new community for board directors, which involves a weekly newsletter, regular events like this one, and structured peer-to-peer discussions. And what a way to kick things off. Today I'm joined by Sir John Thompson, Chief Executive of the Financial Reporting Council, for a session to discuss the proposed government reforms to audit and corporate governance, as well as the future of the FRC itself, or ARGA as it will soon be known as. Sir John has never shied away from a challenge. He left a safe career as an accountant at EY to join a failing local authority, then went on to improve the finances of the Ministry of Defence before becoming its permanent secretary. The HMRC was in a similar mess in 2016 when he joined, sparking a major restructuring and reform of the UK tax system. Now, John is overseeing the most significant changes to audit and corporate governance in generations, spurred by accounting scandals at companies such as Carillion and Patisserie Valerie. Directors will be held personally responsible for the accuracy of their company's financial statements, with fines and bans for major failures, as part of these far-reaching proposals to overhaul UK company rules. The audit profession will also be tackled, reducing the market power of the big four firms and bringing on smaller rivals into shared audits. And these are just some of the ideas of the 230 or so pages of proposals in the white paper currently being consulted on. So lots to talk about, and I want to crack on with the discussion. Before we do so, I want to ask you all to get as involved as possible. There's a Q&A box, so please don't forget to ask questions throughout the session. This is your chance to ask the head of the FRC any questions you wish to, so please do not hesitate to do so. This is the hour we have. And with that, I'd like to welcome John to the session and ask him first to give us some thoughts about progress on the white paper and some of the areas that he thinks will be key for board directors going forward. So John, please take us away.
Thanks very much, and can I say welcome to colleagues. So a brief reminder then, 3 drivers for reform. As you rightly said, first of all, corporate failure, good deal of angst on the part of politicians about corporate failure, BHS, Patisserie Valerie, Carillion, and so on. Secondly, politicians are concerned about the level of audit quality. This is a global problem, and you can see from our annual work that approximately 75% of audits are meeting the international standards, but 25% are not. And then thirdly is the concept of aggressive accounting, perhaps most famously put forward by Kenneth Lay, the chairman and chief executive of Enron, because the accounting standards allow for some judgment to be made by companies, and in some extreme cases, that's being abused. So 3 independent reviews, one by John Kingman, the chairman of Legal & General, one by the Competition and Markets Authority, one by Donald Bryden, the chairman of SAGE. 155 recommendations for change, a remarkable number, covering a wide range of topics. And the Select Committee itself, the Business Select Committee, making another 55 recommendations for change. So that was all woven together into a single consultation document. So irrespective of where the recommendation came, if it was about corporate reporting, then it's included in a section on corporate reporting in the consultation document. Published on the 18th of March last, and a consultation lasting until the 8th of July next. So quite a long period of consultation, because there are a significant number of issues. As you said, 232 pages, 98 questions for people to address themselves. So you can answer one or indeed all 98 if you want to, but covering a very broad range of subjects. Where are we right now? Well, the FRC's managed to deliver 35 of those recommendations in full or thereabouts. We've managed to progress around another 50 or so, but all of the remaining recommendations require some change to legislation, primary or secondary legislation, in order for those recommendations to progress. And that's at the heart of this consultation document. The government's setting out its potential agenda for changing legislation and seeking further input and views from anyone who wants them. And once they'll be synthesized together in the autumn, you'll be able to see what the responses are, and then the government will set out its next stage in that, which would be the passage of primary legislation. So that's roughly where we are.
Fantastic, John. I mean, just give us a sense then. I mean, you say there's 80 or 85 recommendations that have been carried out or progressed, as you say. I mean, what areas are they exactly, and which are the meaty ones, the big ones still to come then through the legislation?
So the meaty ones which are still to come revolve really around three parties. First of all, for companies themselves, there are a significant number of recommendations which are largely about either changing standards or bringing everyone up to the standards of the best in the current market. I want to make a really important point early on. We think the vast majority of companies are run really well, but inevitably in any kind of system, you have some companies that do not keep to standards. And so a good deal of the consultation document is about focusing on companies raising standards or bringing up everyone to the same standard. So that includes things like a UK version of Sarbanes-Oxley. That's a biggie. Bringing all directors into the scope of enforcement, driving up levels of accountability, minimum standards for audit committees. So a big agenda for board directors, and I'm very happy to expand on all of that. Secondly, for auditors, much more for auditors on transparency about what they do, particularly communicating to stakeholders about what have they found, the risks that are being addressed, and so on. And then fundamentally, as John Kingman said, the FRC needs to be completely rebuilt. And that journey is, I think, well advanced, nearly 2.5 years after Sir John published his report.
Yeah. We'll come back to, I think, all those points if we can in more detail. And just to prove that we are getting questions already from the floor, and to encourage everyone just to send them in as we're talking, as your thoughts progress, and I'll feed them into the discussion. The first one is, and this is really difficult, but what is the single most important proposal for the reform? Which is the baby you prefer the best?
Oh, that is difficult. I think anything which revolves around personal accountability is a good recommendation. So I am in favour of a UK version of Sarbanes-Oxley, and undoubtedly you want me to expand on what exactly that means. Yeah. But it does drive a certain level of accountability. People have to take that responsibility seriously. If you make something personal, much more likely that people will do it, much more likely that you'll be successful in your outcome. So SOX would be top for me, fairly quickly followed by audit committee minimum standards and raising the profile of audit committee chairs and the vital work which audit committees do. Those would be my top two. Sorry to pick two.
Always take two if you can. Okay, let's crack on with Sarbanes-Oxley, because I think that's going to be the one which a lot of our viewers at the moment really are worried about in many ways, because I think the initial reaction from the industry was one of concern. I'd say that people are facing some fairly big liabilities, some fairly big rules and responsibilities which they didn't have to do before, and that has all sorts of ramifications on things like cost and burdens and attractiveness of being a board director in any case. So tell us through what the rationale is behind this. As you say, it's personal responsibility, but ultimately, not every director can take total responsibility for their corporate accounts, can they? Or can they?
Well, no, there is not an equal in law. We ought to be clear. In law, under the existing Companies Act, all directors are equally liable. And remember, it's the company's results. So, to some degree, it's when a company collapses, it's relatively easy for some of our media colleagues to say, "Well, where were the auditors?" And the question really ought to be, well, where were the board? Because it's the board that made decisions, for good or evil, which led to the situation, right? And therefore, a strong theme of this consultation document is to place the responsibility on the board. Now, can all directors be held equally accountable for that? Well, the proposal is to change it. It is to change the law so that potentially all directors come within the scope of enforcement by the regulator, by us as a regulator, as they are for the Insolvency Service. That does not automatically follow that we would then pursue all directors in that regard, because some have more responsibilities than others. Members of the Audit Committee, we assume, take much more care and pay much more attention to the financial results than do the rest of the board. I can say that from serving on an audit committee right now of a major organisation. And so we need to be careful about how exactly does this play. And there is a fantastic question about what does this mean, therefore, for directors and supply of directors. And we are very interested in what the people think, because the consultation document re-emphasizes existing liability, which is in the existing Companies Act. It then raises the bar for the audit committee, I think, and then says, but we're making it clear all potentially within scope for enforcement by the regulator. Now, will that make a difference to the supply of non-executive directors? Well, potentially, but we need to be really clear. My thinking about this is it almost certainly does mean more time for non-executive directors. And there is a heightened level of risk driven by that higher level of accountability. And I think what you should expect to follow from that is higher levels of reward for non-executive directors, because they'll be doing more. The risk is higher for them, and logically risk and reward follow. Will that mean any impact on supply of non-executive directors or not? I don't really know, but we are interested in what do people think. So if any colleagues out there have a strong view, by all means email me or the FRC and tell us what you think.
Well, I think already the feedback that we've certainly got from the many articles we've written on this is that they are concerned that people will no longer see it as a particularly attractive place to be, particularly when private equity is very busy and busy building portfolios of companies which require executives as well, which don't fall under the same rules. There is that, and and it will cost them more, and it will become more of a judgment on these people. So, but are you not worried this is going to water down standards actually, because you're not going to get the right people at the right time in the right companies?
Well, I'm not particularly concerned about that, and I think you're pushing away at a rather interesting point, which is what we've essentially been talking about mostly is the addition of further responsibilities onto listed companies, which goes to the heart of what's called the definition of a public interest entity. Now, when we were considering the responses to Kingman and Bryden, it was fairly clear that they were saying that we want higher standards here, we want additional accountability there, and so on. And ministers were very careful in terms of saying, well, hang on a minute, if we continue to add that onto publicly listed companies, it creates even more of a gap between publicly listed companies and privately owned companies. Where you get your capital from will now be a major driver of the regulatory regime, even more of a driver of the regulatory regime that applies to you. And therefore, if you like, the obligations already had a differential, and then the differential was going to rise. Ministers came back to this question about large private companies and whether they were part of the concern which originally drove some of those reviews. And the answer to that is, well, they were. Actually, if you think British Home Stores, it was not a publicly listed company, it was privately owned. Was there as much interest in that company collapsing as there was, say, Thomas Cook? Yes, I think you could argue that. It impacted on communities and on suppliers, and on pension fund holders and so on. And so in the end, ministers said, well, hang it, we will bring into this regulatory regime 2,000 or so large private companies. So to your point about private equity, those companies could well be brought within the scope of this regulatory regime, depending on the answer to one of the questions, which is about do people agree that large private companies should be brought within the proposition is they should, under the weights principles, which I'm happy to expand.
Do you think private companies should be vetted and regulated to the same degree and the same level of standards that you do listed companies?
No, not to the same standards. I think there has to be some differential between those companies who are wanting to access public capital markets and those who are not. And we need to understand that. But I do think it's important that there is a level of accountability on those who run the largest privately owned companies in the UK. And Sir James Waits, the chairman of the Waits Group, came up with some principles which the government adopted 3 years ago now, which said depending on the number of employees, the turnover, and the balance sheet value, the company concerned should be regarded as being an entity which is of significance in the public interest. This isn't just about saying there are shareholders and there's a company. It's trying to broaden out the fact that there are a range of stakeholders in a company: the employees, the pensioners, the suppliers, other financial institutions, and so on. And if you begin to think more in the round, then we're just as concerned about the largest privately owned company as we are about those on the FTSE 350, for example, because there are some very large privately owned companies operating in the UK. And so some of this change is coming their way, subject to people's views about the consultation.
Yeah, I understand. Okay, I'm going to build, just ask two of the questions from the floor. I'm going to build them together because I think they're roughly in the same area, if you like, the two sides of the coin. One, which is that if you're going to make individual directors personally liable, how important do you think it will be to have mandatory training, to bring the standards up in how to be an effective director for all directors? And the flip side is that someone's asking, how can you hold me responsible for approving a proposal which I have no idea? I mean, because I think they're sort of related, aren't they, in the sense that, everyone brings different skills and qualifications. But the other question is saying, well, should there not be some mandatory training to bring all the board up to a level which you're happy with?
So I'm not a great fan of mandatory training, to be completely honest. I mean, I think it's for individual companies to decide what is the appropriate recruitment policies, diversity policies, and so on. Obviously, what we'd like is we'd like diverse boards with a range of different skills. And running a company requires a range of skills, and being a non-executive requires a range of skills. You can't say, everyone needs to be an accountant, or everyone needs a certain level of knowledge, X, Y, and Z. You need blends at the executive, and you need blends at the non-executive level. So I'm not a great fan of mandatory training, but I do think it's really important that non-executive directors keep up with what are the current thinking in relation to, let's say, technology. The advance of APIs, for example, and in terms of integrating systems together and providing digital service to the public, it has been amazing in the last 5 to 10 years. You've got to keep up with how does that work if you want to be an effective non-executive director and support and challenge on the board. So I'm not a fan of mandatory, but I'm a fan of non-executive directors keeping up to speed and so on. How can you hold me responsible for approving a proposal for which I have no idea? Well, we need to be really clear here. The results are the results of the company. They are approved by the board, but people on the board have different levels of accountability. So let's take the extreme example. You're on the board of a PLC, it collapses. What does that mean for you as a non-executive director? Well, the answer to that is it depends on whether you did or did not, in our judgment or the judgment of an independent tribunal, carry out your responsibilities. Now, there are, under these consultation document, there are more obligations being put on the audit committee chair. There are already additional responsibilities on the chief executive, the chief finance officer, and the chair. So those four, in a sense, have a slightly higher level of responsibility than everyone else. If you're not on the audit committee, but you are on the board, you couldn't possibly be expected, let's say you weren't a finance expert, you couldn't possibly be expected to hold to account everyone and go through the accounts and so on. And we would differentiate between people, as we currently do, if we were to do an investigation. So in theory, everyone's therefore in scope, because they're not at the minute. In theory, everyone's in scope, but any kind of enforcement process would focus down on a smaller number of people, those with more responsibilities. But to be really clear, the government is re-emphasising what's already in the Companies Act. It's the company's accounts that are being reported. It's nobody else's accounts. It's the company's accounts being reported and then signed off, or not, but signed off by the auditor. It's a really important principle for everyone to understand.
Yeah. And there's a couple of questions which, again, I'm going to try and merge together. And it's something I've heard before as well, which is the concern that certainly those who have experienced in the US, there becomes a bit of a box ticking exercise And actually boards, it takes away from boards some of the kind of more entrepreneurial spirits and more of the kind of innovative ideas that perhaps, a more freewheeling approach could bring. I mean, is that a concern of yours, that it becomes so, such a administrative exercise as opposed to one where the board kind of creates a certain sense of dynamism and innovation?
Look, I mean, I've never served on the board of a PLC, so let's get that out there, because it's an important factor to understand. But I've known a lot of people who do, and you're right, that is a tension here, because how do you get the forward strategy of the organization, its investment strategy, its further development, and so on? How do you get that in the right balance with being accountable to shareholders and other stakeholders? How do you get the right balance between those two things? I think is always a tension on boards, as I understand, on PLC boards, as I understand it, and it is for the board to decide how to do that with the executive. Now, I'm not downplaying the fact that there is some additional burden here, and the regulatory impact assessment that's been published sets out what the cost of it is, and that cost translates into time and people largely, doesn't it? And it is an additional burden, and you can argue that it continues to tilt towards what people say bureaucracy. But let's be really clear: when a board is spending money, it's spending my pension money, and it's spending your pension money, and it's spending everyone else's pension money, because it's largely that which is funding those companies one way or another. And so there's a level of accountability that comes with that, which is why you're on a public market, right? It's because it's pension fund, it's largely pension fund money. And if what that means is you have to be accountable in a certain way, I think that's fine. There is a quid pro quo, though, which is we also need investors to take their part of this responsibly too, because if you talk to chairs of PLCs, and I do talk to a lot of them, they'll say investors aren't really interested in this, they're not engaged, and they've got to step up to the plate too, because the consultation document gives them more information, it gives them more transparency, it opens the door to the audit committee chair and to the work of the audit committee, and they've got to take that too. So let's not get, whilst this conversation is focused on board directors, there are three other parties to this system, and they've also got additional responsibilities and accountabilities under these proposals.
I mean, I guess there's another tension which sort of comes from that to a degree, which is, and it's a wider government thing, isn't it, about how open the UK is after Brexit, after COVID, to international investors, to international companies to come be based here, to be listed here, and so on. And there is that feeling that if the rules are too strict and the burdens are too much, that might deter companies that we would like to have in the UK from coming here. I mean, do you think this strikes a balance that will enable that to happen, or do you think there's a risk that it goes too far and then people say, actually, well, the New York doesn't have these rules and Hong Kong doesn't have these rules, so we'll just go be based over there?
Well, New York, of course, does have these rules, some of these rules anyway, doesn't it? Look, I mean, it's really vital that investors and financial markets and those who depend on the largest companies in the UK can rely on the information that they publish. And that is where the Secretary of State is coming from. Now, at the margin, do these set of proposals mean London is more or less attractive than somewhere else that you can access public capital? Well, I guess you could argue that it makes it slightly less attractive at the margin. But I would say two things. First of all, we checked with Lord Hill. We went through the propositions in some depth. He was perfectly content that these proposals did not impact on his own review about the attractiveness of London. And the second thing to say is that if you break down the proposals, in some areas, what we're doing is catching up with other with other countries. So on SOX, Sarbanes-Oxley, for example, our version is a planned light version, would catch us up to some degree with the US, with Spain and Japan, all of whom have those kinds of regimes. In some areas, though, it does mean that we would be the first country in the world to implement something. But there is a group of reform-minded countries watching what the UK does and saying to us in private, if you can make this succeed, and it does make a difference to the reliability of information in the market, we would almost certainly follow on. And we've had extensive conversations with Canada, the Netherlands, South Africa, Australia, New Zealand, and now the US is beginning to emerge into that space too, saying, well, these are interesting. What difference does it make? If we can see there's some evidence to that, then we'd be very interested in following on. So that don't immediately slip into saying, well, London's doing something, we'll always be out there as the world leader and nobody's ever going to do some of these things. So I seriously think that they will in due course.
Again, I think we're getting questions which sort of sometimes center around the kind of worries over training and skills and experience and so on. So I just want to ask one more question in that area, which is, one person points out that, that in their experience, board members don't have an understanding of SOX really. So would you like to see there be an intentional requirement that that all board directors understand the UK SOX? And equally, someone else asked, would you like to see some sort of more professionalization of the board, as you would do in the same way as auditors, accountants, lawyers, board directors? Should there be mandatory again? I know you don't have mandatory, but should there be qualifications which should be brought in there?
Well, I think if you're going to be on a board, you need some understanding of. So first of all, you're bringing something to the party, aren't you? So, you might be bringing a fantastic career history of being a digital leader, in which case that's obviously the skill that you're bringing to the board. But you need some broad understanding of how the rest of the organization works. You're not just limited to your discipline, and you weren't in your executive career, and now you shouldn't be in your non-executive career. Does that mean you need a passing understanding of how the finances work? How does internal control work, and so on? Yes, I think you do need a passing understanding of that. Now, your level of knowledge doesn't need to be the same as the chief finance officer or the audit committee chair or the audit committee members, but you need to at least understand what they're talking about, in the same way as they need to understand what you were talking about in relation to, technological advances, and so on and so forth, right? So it's enough to understand what the conversation's about, but you're not the expert and you're not the leader. And that applies when you're a senior executive, and it applies when you're a non-executive. So the question of professionalization, well, there are some people out there who are essentially professional non-executive directors. Now, the corporate governance code guidance actually does already say people should be limited to 3 non-executive directors of PLCs. And because you need to put in a certain amount of time to understand what's going on, we think 3 is enough. But there are people out there who do essentially do it all the time. They make a career out of it. Great for them. Wouldn't quite be for me, but I can understand how they can do it. We're not looking here for professional non-executives, but I do think the overall obligation on non-executive directors has gone up, and the time on certainly probably does go up, particularly if you're on an audit committee. But there's a really important point here. If you are already a well-run company, you understand internal control already now. If you're a high-performing company with a well-run audit committee now, these changes don't really make any difference to you. Remember what I said, the vast majority of companies are run well. What you're trying to do is target the small minority who are not run well to get them to raise standards. And by giving us powers, we can intervene. I could give you a very practical example on the corporate governance code if you wanted me to.
Please.
So we identified a company which was listed, and its disclosures in relation to the corporate governance code were essentially largely non-compliant against the 18 principles. Saying we're non-compliant with 8. We don't really care. We're putting it out there, and so on. Now, at the minute, can we actually go and intervene with them? So we wrote them a fairly sharply worded letter saying, as a regulator for the corporate governance code, X, Y, and Z, we note that you're largely non-compliant with the code. We don't really think this is an acceptable situation. And what they essentially did was to say, fine, well, we'll come off the capital market, then we'll go into our private market. And you're like, well, hang on a minute. We can identify a company that's not well run, but we don't really have any powers to enforce for them to raise the standards. And interestingly, people are quite disclosive about some of the proposals here. So the other day I was talking to the audit committee chair of a PLC who said, yeah, I think this is a lot for us to do. And I said, well, why is that? And he said, well, the audit committee consists of me. I'm the audit committee. And you're like, really? I mean, that doesn't feel right to any of us on this call, does it? But to re-emphasize the point, that is the exception. Oh, not the rule, right? So we just, what we're trying to do is to is to identify the exceptions and get them to raise standards. And you need powers to be able to intervene and target your intervention, not on the majority, on the minority.
And those powers include fines and potential bans or temporary bans for directors. I mean, how often do you think you'll be needing to use those powers, those sanctions?
Well, that is a really difficult question to answer, right? We just don't. It's very difficult to size it from here because until you've actually got further into it and can identify, well, look, there are currently 2,000, just over 2,000 companies within our regulatory scope. The proposals would increase that to 4,000. Of those, a small handful would be in this kind of extreme group where they're largely non-compliant, don't really care, but somehow still manage to keep going and attract capital. So it would be a small number. To give you some sense of it, at the minute, we currently have 41 enforcement cases following the collapse of a company. That number has been growing over the last couple of years, but 41 out of 2,000 is a relatively small percentage, and I guess you could probably extrapolate that and say, well, maybe the number will be low tens over a period of time.
Yeah. Some of the questions we're coming in are really asking about the kind of the backdrop of all this, and why reforms are needed, and indeed if the reforms are being led by the FRC or imposed on the FRC by the sort of taskmasters who have obviously decided that things aren't good enough right now. I mean, so in your view, do you think the FRC was asleep at the wheel for the last decade? And how culpable is it for the various sort of scandals we've seen in, as you say, BHS, Carillion, Patisserie Valerie?
Well, you're asking me a yes or no question, to which the answer is yes. Sorry to be so straightforward about it, right? I mean, I think. Well, I think the thing that surprised me was Kingman was published in December 2018, and I took on the job in September 2019. I assumed 9 months had gone past, and a number of the recommendations would have been progressed, but actually the number that had been progressed was really quite low. There wasn't a program of change, a cultural change of increasing the organization's capacity and capability, and it became fairly apparent to me fairly early on that, if anything, Kingman was generous in terms of his recommendations. I know him well. I went back to see him and said, "Wow, why did you not talk about X, Y, or Z?" And the answer to that was, once you made 83 recommendations, you essentially, as he said, you're saying you got to completely rebuild the house. How much further did you need to go? Now, so that we've been doing a lot more than the 83 recommendations in terms of rebuilding the organization and its systems and its processes and its transparency and its capacity and capability. But we do need the legislation to turn us into Arga to have more powers. And I could give you examples of why that is. Were we therefore sort of complicit or in some way responsible for corporate failure? Well, it's probably arguable that as a regulator we weren't anywhere near as strong enough, we weren't big enough, and we weren't transparent enough to be able to actually make a difference to the system, so that the system was more transparent, so that people could get the information they needed to impact on the Carillions and the Patisserie Valeries of the world.
I mean, as you say, the reforms were so delayed as well. I mean, and then in those sort of 3 or 4 years, 4 years and 3 reviews, we've had NMC Health and others. I mean, why was there so many delays, and why weren't things taken forward at speed when it was pretty clear that things needed to happen?
Well, I don't know why the FRC itself didn't take the action which it was kind of staring itself in the face. I mean, I think the FRC was not a very confident organization. I mean, it was slightly hidebound by, or can I not use these legislative powers, or I haven't got enough powers, but then don't say anything about it, don't really move forward, don't think about the public interest of a series of corporate collapses. And stand back far enough to say, hang on a minute, we haven't got the capacity and capability, we haven't got the powers, we need to elevate that to another level and get ministers to change it. It took an external party to fundamentally challenge the FRC to what it was doing. Now, I think, so to illustrate, we're, I think, a much more confident regulator than we were, still much more further to go. So if you took operational separation, which is a significant development for the audit, the Big Four, where we're essentially putting the audit practice at arm's length than the rest of the firm. That was done without any legislative backing at all. I mean, I sat down with one of my directors, and the head of Deloitte's actually was the first one, and said, this is the direction of travel. Do it with us, or I will use other levers that are available to me to sort of to get you to do it. And to fair dues, they said, right, okay, well, how do we get it done though? We want to raise standards and we want to go down this route. Much better to negotiate something and make it effective. Now, that took some confidence from the organisation to step forward, say we want some change, get that change done, get it negotiated, bank it, and now get them all on action plans to get it delivered. That the old FRC of 3 years ago would never have done that. It would have sat back and waited for somebody to tell it. As to the ministerial and political dimension on this, I can't really comment on why is it taking as long as it's taking. All I can say is the current Secretary of State's very engaged, as is Lord Callanan. I've discussed it a number of different times. Lord Callanan totally behind the consultation document, and he's out there now talking about it and engaging in webinars and seminars with people to try and explain the political rationale for why this needs to happen. But I think we are looking at a timescale of ARGA coming in probably in 2023,
which is a long way away. To be fair, that's still 2 years before we see the new regulator then.
Yes, and what that means is for the corporate reporting changes are for companies and the impact for board directors, they probably won't see that until 2020. The year end, December 23, might be the first year for them to report. And the package is so significant for companies, I think, that we are contemplating it being in two sets of packages, one in 23 and one in 24. So actually you won't see a mature situation, I don't think, until 25 probably, from a report that was commissioned in 2018, and that is a long time to get this changes underway. But there have been other significant political pressures, so I can't really answer for where ministers are.
What's in the second package? What's in the 2024 package? How are you?
Sorry, I wasn't meaning to scare anyone that I've got another list, just in case we're not really understand this. So the package which is here, I think for companies is really quite significant, and I don't think we can reasonably land all the changes on corporate governance and the changes on corporate reporting and SOX and a range of new obligations, for example, in relation to fraud. I don't think you can land those all in one package and then say, right, we want it all reported from the 31st of December 2023. I just think that's too much to expect, and therefore what we're contemplating is breaking it into two packages. We might have a shadow year and then a full year, or you have some in 23 and some in 24. I just don't think it's reasonable to expect everyone to be able to take it all in one go. That's our current thinking.
Yeah, I mean, do you anticipate a big refresh of boards around that time? People scarpering potentially, but also coming back in. I mean, there'll be the sort of a bit more of a turnover, I suppose.
Well, I mean, there is the market has reasonable levels of turnover anyway. Do I anticipate that some people look at the margin? Some people will walk away from this. But to emphasise the point I made earlier, it will also opens up the possibility for a wide range of other people to come in, because actually, if what we say is to be a FTSE 350 director means you're going to have to spend 6 days a month, and this is the kind of risk profile of that, then I would expect the reward to rise. It becomes an attractive proposition because risk and reward go together, and some people they'll find that more attractive than other opportunities which are available to them. If you can get 100,000 for 6 days a month, then you can do 3 of those. if that's possible to juggle all of that. I mean, there are people out there who'd want to do that, and it can extend your career for really rather a long time.
I've got a question coming from the floor, and it picks up on one of your earlier points, actually. I think it's a good question. I mean, do you, because you talked about the global consequence of what we're doing in the UK, and the dialogue with other nations. I mean, do you envisage a better alignment of corporate governance requirements more globally as a consequence of the review? And how does it tie, I mean, and this question is building from me, but how does that tie in with the international standards that clearly you guys are so involved with at the moment?
Oh, what a great question. So the challenge with international standards is they move very slowly. Getting a change, because you have to negotiate with a wide range of different places. So the truth is, if you took audit as an example, the international audit standards have been set. What happens in most domains is that some local additional requirements are placed on top of the international requirements, because changing the international requirements requires 57 domains, I think it is, to be able to give a view about, or do we not want to change it, and therefore it takes a long time. You're reasonably thinking about 5 years to get any significant changes to international standards. So locally, you can move much quicker by changing your local standards, and then as they promulgate into other domains, then you can make a much stronger argument about, well, really, we need to change the international standard now because 17 of us are doing X, Y, and Z. So can't we change the international standard? That produces you a much better outcome. Now, this is particularly relevant if you talked about ESG reporting. So we all know about IFRS and accounting standards. Actually, what we really need is an IFRS for non-financial reporting. The impact of a company on climate, for example. Can we get to an international standard on that? It's going to take quite some time. Meanwhile, we as a reasonably agile regulator can say, okay, well, we'll do something locally in the UK. This is what we think is a good standard, TCFD, supported by the Sustainable Accounting Standards, right? There's a good combination. That's best practice. The majority of companies move that way, whilst we separately negotiate internationally for international change to get that adopted, and then it can permeate back the other way. Does that sort of answer the question about international?
I think so, yeah. I think also about how, I mean, very practically, the question also asked a sort of secondary point around dual listed companies, and if there is cooperation between, I don't know, let's say the UK and Canada. I can't think of any dual listed Canadian UK companies off the top of my head. Yeah. Hypothetically, that would presumably help from an investor point of view and from a board point of view.
Yes, it would. So SOX is the most relevant one there. So there are 50 dual listed companies, I think, on the London market. Now, so whatever Sarbanes-Oxley regime we design, it needs to accommodate the fact that those companies are already doing something for the US listing. And we would not, I'll make this commitment absolutely in public, we would not impose additional requirements over and above those which are already there to meet the US standard. The US went first. It's what, 18 years, I think, nearly since it came in, something like that. It's no good us now going to say, oh, well, we completely reinvented the wheel and wanted this additional thing. That will be enough. No additional burden. No additional burden there. And then in financial services, the senior managers regime with the FCA already exists, has many similarities to Sarbanes-Oxley. So whatever system we design needs to accommodate both of those, and we need to be very savvy about doing that. And what that requires for us to do, to be transparent, is we kind of conceive of a co-creation. So one of the deliberate moves I've made as chief executive is to be much more outward focused, talking to a lot more people. So when we began to think about Sarbanes-Oxley, we went to the Audit Committee Chairs Forum, had a very open conversation with them. Actually, they volunteered to do some work for us. I think it's about 80 of the FTSE 350 Audit Committee chairs. They grouped together. They did some work for us, came back to like a very practical way for you to move forward. Be like this. It seems to me there's a range of these propositions in the consultation document where that kind of co-creation with people who actually got to implement it has got to be the right way forward, rather than sitting in some policy white tower and saying, aha, here's what you all ought to do. We have to be much more engaged with colleagues about how to achieve the outcomes we want to achieve.
Very good. And I've got again some questions now regarding the audit side of things, which we haven't really discussed. I'd like to go there next. I mean, just you talked about right at the beginning, 75%, 25% split between sort of good, bad, effective, ineffective. I mean, do you think the reforms as they stand at the moment go far enough to try to address the dominance of the big four firms? And I want to specifically ask if you think the shared audit route is going to be the most effective one, because clearly what was dropped is the joint audit proposal.
Okay, so three things. Do they go far enough? They go far enough in legislative terms. Will they be enough to solve the audit quality problem? No. Because what we are relying on are the audit firms to do three things. First of all, change their methodologies. Secondly, to significantly invest in technology. And thirdly, to invest more in their people and the culture. So those three things, we can see most of the big firms doing all of that. And some of them are spending enormous sums of money on methodology changes and technology changes and so on. So the combination of stronger regulator, some of the changes for auditors, and what they're actually doing, I think we will see audit quality rise, and we can begin to see some early signs of that in the work that we are doing. Do I think this will make any significant difference to the big four? Not in the short term. Not in the short term. The people who were asleep at the wheel allowed this market to fall from 8 to 4. I mean, you're probably old enough to remember a big 8, and I certainly am. Now we're at a big 4. They are too big to fail, in answer to Charlotte's question. So we're in this kind of place where we got these 4. What we really need to do is focus on the capacity and the capability of 5 to 7, I think, to be able to increase themselves to a point where they could reasonably compete for bigger audits, which takes you to joint audit versus managed shared audit. So joint audit is very effective in France. It's the neighboring country, long established and so on. But the only significant difference between us and France is the liability laws. So in France, liability of auditors is capped using various different formulae. Now that here we have a long-standing tradition that auditors' liability is uncapped, it's unlimited, and this has been tested, I think, on a few occasions. I'm not familiar with this. It's been tested a little with investors to say, well, would you accept a capping of the auditor's liability? To which the answer is no. And secondly, changing the law on capping the liability of auditors is unbelievably complex. So looking at it, the joint audit would work if you could change the liability laws in the UK, but we think that's too difficult to do. So what we've done is come up with this thing called managed shared audit, which is to copy as many of the features of joint audit at the operational level. How do two work together? How do they share it, the work? How do they report together? What goes to the audit committee? So on and so on and so forth. But we have to deal with the liability issue. We cannot expose the smaller firms to the liability. The smaller audit firms to the liability of auditing, say, a FTSE 350 company. It's just too much for them to take on. The cost of it's too large. So we are navigating our way around that with this thing called managed shared audit, but it shares very, very many of the features of joint audit, which we don't think is implementable.
And to some degree, it also shares some of the burdens of the joint audit. And are you worried that the smaller firms may just not want to take part because they haven't got the experience, they haven't got the personnel, and they haven't got the desire to be part of that game when they can just quite happily audit what they audit at the moment?
Well, that is clearly a business decision that they have to take. Look, we should respect the fact that Grant Thornton 2 years ago, I think it was now, decided to withdraw in large part from the public interest entity market, sort itself out, regroup, sort out its audit quality and its methodology and so on, and then come back into the market. And we have to respect that. Meanwhile, BDO and Mazars, because those are, I think, 5 and 7 in the current UK market, have grown their practices really rather well. And there have been some notable wins from both of them in the UK market, but they still haven't impacted on the FTSE 350. The thing that's really important is to talk to audit committee chairs. What do they want from an auditor? What they want, they consistently say this, is an auditor who understands their industry and has the capacity and capability to do their audit. Now, if you're a challenger firm, let's use that term, and you're wanting to bid for a bank, you need the experience of doing a bank. And one way to get that experience is to be the smaller partner of a larger firm on Barclays or HSBC, say, in order for you to knowledge your capacity and your capability. And then smaller banks up the lower end of the FTSE 350, you might be able to still a commercial decision. But now in a much stronger scope for the audit, say, to 25% of Barclays, which is equivalent to 100% of you. So now we'd like to bid to do your audit. That's the way to build up their capacity, but it's a slow burn. It's going to take a long time, which is why the CMA said they would come back in another 5 years to see whether the market had shifted. The government proposes to give us capping powers, so we could dramatically alter this market by simply limiting the work of the big four. So they all had a 22% market share or something. Let's say we capped them all out, and that would leave the other 12% to be bid for by non-big four. But that would be completely random, and it's not really an area where I want to go, because it essentially depends on the flow of audits which are up next and whether you've reached the cap or not. It just seems a bit of a bizarre way to do it. So although the government may give us those powers, I don't think in any short term we'd be looking at using them.
Yeah. So even though, as you say, this might not have a significant effect on the big four in the short term, you're going to see how it goes and see if it works in 5 years' time, revisit and take it from there. Is that the plan?
Yeah, and they all look. All the firms say there's lots of work out there. This is a market which is inflated by roughly 6% a year for at least 5 years. So there is a lot of work out there, and Sarbanes-Oxley potentially puts additional requirements into the mix, as does the extension of the audit into the non-financial reporting at the beginning of the annual report. So there will continue to be questions about capacity and capability of this market to deliver everything that's now required. We do recognise that, and that's why there's one of the questions in the consultation.
So I'm to the point of the future. Then there's 5-10 year vision. Is this it? Can boards be kind of reassured that once this gets enacted in 23, 24, maybe 25, that's the extent of the changes they've got to face in the next decade? Or will there be further work on the corporate governance code, on the stewardship code, on, as you say, the large private company codes and so on? Is there more to come? Is there more work that you need to do on all those different areas before you're happy with where the companies are?
So I think the obvious top of my list to change, which is not in this consultation document, is consistency in relation to ESG reporting. There is no international consensus. I mean, everyone's saying, TCFD, great, we can all get behind TCFD, but that doesn't have any metrics in it. So that's why we say TCFD plus the sustainable accounting standards. And I think that deals with the environmental aspect of it more about S and G. And I think that will need to develop further, and we will see further developments in that area. And we are indeed looking at what is our contribution towards ESG reporting and what is our international. So that's top of my list.
So just to be clear, is that a code or a new bit of legislation that you need to come up with?
I don't think we potentially need any legislation, but I do think if the UK can consistently be seen to be getting reporting against TCFD with some metrics from SASB, actually that then becomes the market consensus about what to do. Do I need a legislation to do that? No. There are some companies out there doing fantastic reporting on their impact. They're the market leaders. The market will move that way. It's just the nature of the market. And then as the regulator, post being ARGA, Our job will be to intervene with the ones who are not doing anything at all.
Mm.
So I don't envisage any legislation. There will continue to be changes to the corporate governance code because it's on a 3-year revision cycle. There'll be further tweaks to that. Can I see anything significant in that space? Probably not, to be frank about it. I think there's also some potential for a Waits 2, if you're familiar with Waits. James Waits did the corporate governance code for large private companies. I wouldn't be surprised if the government asked him to revise that and think again post Arga being born. But those are 3-4 years away, probably in my head.
Yeah, it's been a busy time. And so, and just tell me through the obviously last 12 months has been crazy in many respects from a corporate governance perspective. So many ups and downs, and so many things to consider. I mean, do you think listed companies and companies as a whole are coming out of the pandemic in reasonable audit shape and reasonable corporate governance shape? Firstly, and secondly, the FRC's put in place and was very nimble in doing so. Lots of areas where just where companies could sort of take a different stance given the restrictions of COVID. I'm thinking things like virtual AGMs and other practices. Which of these do you expect to become permanent going forward?
Well, I think the majority of companies done really, really well. I mean, let's be upfront about it. It's a really, really difficult time, but we also ought to acknowledge the fact that insolvencies have reduced quite significantly in the last 15 months. So there has to be a question about whether when the government begins to release financial support, what does that mean for insolvency levels in general in the economy? So I do think the majority of companies have done fantastic. There are 3 things they've done. One is to be more transparent about the impact on them of the situation and what they're trying to do. The second is, what does that mean about their risk management? And again, I think they've done really well at being transparent and engaging. And then thirdly, how do you engage in relation to virtual AGMs? I think, and we published some best practice on this. I think actually there have been some great best practice out there. I mean, I think if you can engage more retail investors in that way, I think that's probably a good thing. So I'd probably keep all 3 of those things: more transparency about the situation, forward risk, and virtual AGMs. That's not to say there's more to learn in those spaces, because there is more to learn, but undoubtedly those are sorts of things to keep.
So presumably you won't see only virtual AGMs because you wanted people in person to go to their shareholder meetings as well.
Yeah, it'd be nice to meet someone again, wouldn't it? It'd be quite nice to get out of this office after 15 months of sitting here and chatting to people on things. Yeah, we want to get back to that, but there are other ways in which you can engage shareholders and stakeholders, and we're beginning to move towards thinking about the future of annual and corporate reporting in a sort of modular way. So we did something called the future of corporate reporting. We consulted quite widely about that. I mean, the sort of one-size-fits-all requirements from the government. We think a more modular approach that says, well, okay, I'm a retailer, therefore these are the sort of top things I need to report, might be, in a modular way, might be better than one size fits all. You've all got to do X, Y, and Z, because it doesn't really apply to every single company that's listed on the exchange.
Yeah, no, that'd be so. But what was the? Because I looked at that, and from the consultation you did on that, what were the main findings from you? What do you think would be taken forward from that consultation?
So I think first of all, everyone says there are too many burdens coming from government. Massive amount of reporting, and some of the larger companies, annual reports running to 400, 500, 600 pages long. I mean, an incredible amount of detail. A lot of which is coming from ministers want you to report A, B, C, D, E, F, G, and then and over the years you get this accretion of requirements. So first of all, that's quite significant. So second of all, what can you do to tailor that? And that's where we came to this kind of modular approach. So if we took all those requirements, actually, some of those requirements apply to these sorts of companies. Well, let's get those to report that, and then we'll take the rest of them out, which then makes it a differential kind of model, but overall reduces the burdens for all, but in a different way. And there was a great deal of support for that. So we're now just working up how we would get it done.
Two last questions before I let you go. First of all, on board diversity, and it comes to one of the questions we've had from the floor around boards are being still too conservative in picking new directors, and they mentioned a couple of which have had to resign recently. I mean, do you think that's still the case, and do you think the FRC or ARGA will do more in terms of encouraging board diversity above and beyond the gender diversity push the government's already put in place, but maybe mandating things like the Parker Review?
Yeah, we will continue to push board diversity. Incredibly important that boards reflect more of the society that we all live in. We did all of the work, the sort of data work for Parker, so we're very, very close to that work, and we will continue to push board diversity. We'll continue to look at best practice. We'll continue to highlight that through our FRC lab or through our corporate governance work. We'll continue to be part of that push for improving diversity on board. So yes, it's a straightforward answer to that.
Yeah, and last question, and I think hopefully wraps things up a little bit, is what someone asked: do you believe these reforms as a whole would have prevented some of the problems that have occurred with Wirecard, for example, in Germany, or indeed, retrospectively in some of the scandals we've seen in the last decade?
To some degree, I think these reforms would have slowed down or made it much more transparent about what was really going on. And that's part of it. We have to accept that in any kind of capitalist system, the taking of risk generates reward, but on occasion it will create failure, system failure. And the question is, to what degree are politicians comfortable with system failure? And they're uncomfortable now. And the way to address that is to say, well, we'll have higher standards, more transparency, some new obligations on that, drive up accountability. So that means that those who need to be engaged here, investors in particular, can say, oh, hang on a minute. Now we really understand that you're being really aggressive about this accounting and you've got these risks, and put more pressure on companies to do something about that. Will it absolutely prevent corporate failure? No. Those will still carry on, but I think the market will know earlier. It will be able to engage earlier and be able to put more pressure on getting the company to do something about the situation that it faces. But we can't eliminate failure in the system. Sorry.
Yeah, well, this is it clearly is pushing in all the right directions. So, John, thank you so much for your candor, for being so transparent, as is indeed your mandate. It would appear to push through for companies as well, giving us some guidance about where you think the direction of travel is within FRC and ARGA, the timetable. All those things are so interesting, and from my point of view, just news, to be honest. I mean, so which is fantastic, and I think really good to hear. Normally we'd have some sort of round of applause and hundreds of people in front of you giving you their thanks as well. But so unfortunately we haven't got that today. Hopefully next time we do this, we'll hopefully be in person and we can have a drink afterwards as well, which is what I'm most looking forward to after the pandemic. So, but all I can do is say thank you once more, and I hope it's gone well for you as well. Thank you.
Thank you.